Ooh, what is going on? Happy Friday. It is Financially Fluent Friday. Zach Kraft here with you. Sarah couldn't join us today. She's on the road doing some family stuff, but she did ask me to say happy Friday to everybody. And if you have any questions or you need to reach out to an agent, she says feel free to reach out to her. She'd love to answer any questions for you. But I did want to jump in and talk a little bit about a couple things that are on my mind that I've been seeing in the news and also just in general with some of the scuttlebutt on social media. And I think it's really important. There's a lot of good things happening right now. And I think that it's very important that we start to notice these shifts and these changes and take advantage of them. And I think the first thing to really start to talk about is that we've seen a little bit of a shift in the housing market. And I hear a lot of doom and gloom. I hear people talking about, oh, the market crashing and blah, 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 blah. And realistically, that's not what's happening. What we're seeing right now is that values have started to calm down a little bit. There was a point where people were kind of shooting the moon. There was the buyers who saw the interest rates starting to go up, got scared and were essentially putting some pretty crazy offers together, and they were getting out there and being very aggressive. Now, for them, it made sense because they wanted to take advantage of rates when they were in the low three or in the threes and in that range. But as we've started to see interest rates rise up, the higher price points just aren't making as much sense for buyers. The affordability is not there. And so you've seen the demand start to go down. At the same time, you've seen a lot more houses come onto the market with people who are wanting to leverage the equity in their home, whether they're making a move or, there's any number of things that push people to sell their homes, and whether they want to step up because they need a bigger home, which is something we're looking at because we have twins on the way, whether they're making a move, whether they're just retiring, death in the family, all those things that happen. As a matter of fact, one of the houses down the street is actually on the market right now, or going to be sold very shortly, because unfortunately the owner of the home passed away and the kids are selling the home. So those are the types of things you're seeing happen, and we've seen a major jump in inventory. So that's available homes is the term we use in our industry, is inventory. So with a lot more available homes on the market, what we're seeing happen is the prices there's a lot more competition for the sellers, and that's helping out in terms of the buyers, because now you have some options and you're not having to jump on that 1 in a million property that pops up. So what that's had a net effect of doing is it's ended up dropping the prices a little bit. Not crazy. We're still seeing year over year gains, and we're still seeing bottom line is it's going to be a lot more. It's still a great investment because you're going to see equity gains and you're going to see long-term growth, but they have dropped a little bit over time. Nothing huge, but enough that it's something we're talking about. At the same time, we all talked about inflation. We all know about inflation. We know what's going on. At the same time, the government's been really aggressive in trying to attack inflation. The Federal Reserve, the Federal Open Market Committee has raised interest rates. Everybody talks about that. And I mentioned this last week when we talked about it, and I talk about this a lot. The Fed raising their rate, which has nothing to do directly with mortgage rates. And as a matter of fact, what it has done is help mortgage rates. Over the last month to a month and a half, we've seen rates calm down and drop. We've seen them now. I don't know if the news recently is that they're under 5% on average, which is great. I've been contacting a lot of my clients that were kind of on the sidelines because for them, the rates where they jumped up to in the last 5 months, 3 months, were just not affordable. They got to a point where the rate shifts had made them out of the market. Now we're seeing massive changes. One of my good clients, a good friends, and a client has been shopping for a while, and it was a major eye opener for her. We'd seen just in the shift over the last couple of month or so, we've seen almost a $500 drop in her overall monthly payment for what she was looking to shop for. At the same time, one of the houses she was looking for actually dropped in cost about $30,000. So it's getting to that point where we're seeing a shift. Are we in a buyer's market? Well, we're getting there. I don't know that I'd say it's necessarily shifted specifically to a buyer's market, but we're definitely not in that crazy seller's market that we were in before. So we're seeing a shift, and it's working in favor of our buyers. And so what I would say is this: if you've been on the fence and you've been priced out for whether it's the price point or whether the rates were too high and you were a little bit wary of it, talk to your loan officer. I know a guy if you need somebody. Talk to your realtor. Get some information on an update. Get the numbers. And if your loan officer is not reaching out to you because of these shifts and you've been working with them for a while, find another loan officer, because those of us who have been in this business for a minute and have a strong base of clients that have been, we want to we want to hear that they all my clients that have kind of had to hold off for whichever reason are able to take advantage now when these shifts happen. Now rates change all the time. Are we going to see them go back up? There's a possibility of that. Are they going to stick here and stay stable? Well, realistically, there's a lot of things that go into interest rates, and I think long term we're not going to see them dip back down to the crazy low levels we saw for the last couple of years. But they have calmed down and they've made it a lot more realistic. And still, realistic, historically speaking, we're very low as far as those are concerned. So the market has shifted, and it's going to continue to kind of calm down a little bit. The question is it time for you to take advantage? Talk to your loan officer; they'll let you know. Now, another big change that I am really excited about is there's a down payment assistance program that I love working with that has made a major change. So typically speaking, most of the down payment assistance programs have a credit limit, a credit score limit. They're going to have you at 640 or above, and it kind of, there's different tiers depending on the program. One of my favorite programs, called the Chenoa program, completely changed things and put it kind of on its ear. And now you can get in for as low as 600 credit. Now that's pretty darn awesome. And for people who don't have money set aside or don't necessarily have all of the money set aside, you can utilize this program even with their credit as low as 600. I can't tell you how many people we've got kind of getting moving forward now because they were trying to work on their credit, but they weren't quite there yet. A lot of times when you see is older credit issues delaying you and older things like that stop you. And then, it takes a while for those things to fall off. Even if you've managed your credit great since you had a negative credit event, it can put you in a spot where you end up having to wait just because the time for those late payments to stop impacting you, those collections to kind of drop off that you've paid off, or those negative things that you've taken care of in the past. Sometimes all you can do is wait. Well, now you can get in for as low as 600, and it's open doors for a lot of people. Now, the down payment assistance programs, there's a lot of them, and they're very different depending on which program makes sense for you. With this particular program, the rate's based specifically on how much assistance you use. Most of them are that way. And so if you use, they'll give you anywhere from 3 to 5% for assistance, and it's just a great option. But the biggest thing is that the credit score limits for this program have dropped down to 600. So if you were on the fence because you couldn't get your credit score up, you've been fighting with your credit score, all of the things that go into that, well, now it's time to at least take a look at it and see if it makes sense for you. The numbers may not make sense, but realistically, the door is open now for a lot of people that maybe it was closed for previously. Last thing I want to talk about today is, and this is a huge thing. I've actually been able to help 2 clients with this right away, or kind of got them moving forward with this to look into this right away, is the changes with the student loans for federal debt and for FHA loans, the FHFA. What happens if you've been defaulted on a student loan over the last couple of years, or when they've had these student loans on pause, basically, where you haven't, on the forbearance programs where you haven't had to pay them, you can't really get your student loan out of default until you get in and start paying them off. Well, they're changing that now. They have Operation Fresh Start, basically, that's going through and putting people in a position where at the end of this month, when things get shifted, when they start the state payments back up again, they're going to get rid of these defaults. I have 2 clients specifically that had been on hold. One was going to start to aggressively pay their student loan off in order to qualify, just so they can get it out of default. Well, now they're not going to have to do that. We're going to be able to just use the standard payment for them and put them in a position where they can qualify much sooner. And it's a big deal. Student loans, a lot of times, there's been this interesting thing where they've been in default or they've been in forbearance over the last couple of years. It's been helpful with the pandemic and for people that maybe haven't been able to pay them, or they've been impacted with work and all that sort of stuff. But if you had any missed payments before the forbearance started, you were paused. There was nothing you could do to change that. Well, they've made the changes now. It should be taking place. It should be going into effect at the end of this month, beginning of next month, when they bring the student loan payments back online. So, well, you will have to start making student loan payments again. They've made it easier for you to get out of default. They're going to actually remove you from default. And also, they're going to make it a little bit easier for the income-based repayment plans. There's some other details that go in there. What I would advise for you, if you're someone who's been impacted by this, if you've had the defaulted student loan because you missed one payment and then they put it in forbearance and all that sort of stuff, contact the student loan servicer, get some information on it, get yourself set up so you can move forward and take advantage of it as soon as the time comes. So that's it. That's my 10 cents for the day. Sarah will be back with us next week, and we'll have a couple other great topics to cover. But if you have any questions, if there's ever anything I can do to help out, always feel free to drop me a message, drop a comment. If this is helpful to you, obviously like, comment, share. But either way, make it a great day. Happy Friday, and have a great weekend.